I want to do a little bit more on chapter 13, which is um, top top performers or chasing the top performers and market timing. And one thing the students in 216 seem to like is just examples of why active investing doesn't work. And actually it many times, I mean, in any given time period, you can look at all the mutual funds that are out there. And again, there's nearly 30,000 of them. And you can compare the passive ones, which are index funds, to the active ones. There are going to be many, many active mutual funds that outperform the index funds in any specific year. But when you start to look at longer time periods, the index funds come out in ahead because the active funds are typically really volatile and have very high fees. And after you consider all of that, over the long run, that starts to catch up with them, with the actively managed funds. And that's when the index funds tend to outpace the actively managed funds. And it's all like and this is a really big if you could accurately predict which actively managed funds were going to do best the next year and then buy them at the beginning of that year and hold them throughout the year, then you would do really, really well. But it's incredibly difficult, if not impossible, to predict which funds are going to do the best in any given year. And the ones that do the best in one year tend to not do the best the next year or the next year. So and that was addressed in my Chasing the Top Performers video that I did earlier. But finance researchers like to study these things, and we have examined thousands of mutual funds for decades, and we just have not found any way to consistently to figure out which mutual funds are going to do the best before they do the best, and that would give us the ability to invest in them before they do really well. Buy them, hold them the year they do really well. Um, a guy named Paul Merriman, who actually is a graduate of Western, and then he started his own investment advisory service and managed nearly, I think, $2 billion over his career. But he likes to break the investing community into three different parts. He calls it Main Street. And Main Street would be like your family and your friends. And they might give you advice. So, you talk to your parents and they've invested in a certain stock and it's done well, they're happy about it and they recommend it to you. Or the same with your friends. You see that they've invested in a stock and they're making money and you want to be in the same position, so you buy the stock. But they don't necessarily have the knowledge and they only have perhaps their own experience. They don't have um, the wisdom of looking at, and I don't mean to disparage anybody, but maybe the whole picture where they've evaluated lots of different investments over many time periods and considered the alternative, which might just be to buy and hold an index fund to compare it how well that did. There's also Wall Street, which would be, you know, companies that are trying to sell you something, brokerage firms. For instance, they want you to trade stocks. You pay them a commission every time you trade a stock. They make money that way. Uh, Financial newsletters who are websites, and they write stories about the next hot stock. Um, they want you to buy those newsletters. They want you to read their websites because it brings in advertising dollars. If they write boring stories about mutual funds, sorry, index funds, um, those aren't exciting stories. They might not bring that many eyes to the page. So you always need to take what Wall Street recommends with a grain of salt, with the realization that they are trying to sell you something. And then University Street, which is basically professors, researchers who aren't trying to sell you anything. They're really just trying to figure out what exactly makes, you know, this particular portfolio strategy work. Does it work over the long run? Are these types of stocks good investments? So University Street is where we get a lot of those numbers, like how has the stock market done? If you invest in small cap stocks over the long run, what sort of risk do those stocks provide? What sort of return do those stocks provide? And again, they're not trying to sell you anything. They're really just trying to satisfy their curiosity and pass that information along to others. And University Street has been studying investments and investing for many, many decades. And now we have, 100 years. We even actually have several hundred years worth of data on individual stocks that have been around that long. And then, 50 or so years of data on mutual funds. So we have a lengthy time period to evaluate things. And what we do as researchers is we'll study these ideas and then we'll write a paper on it and publish it in something like the Journal of Finance. And a guy named Mark Carhart actually did this very thing. He studied mutual funds, thousands of them, not just a dozen, for a long, long time period. And basically, he found that there was no specific characteristic of that mutual fund that suggested that it was going to do better consistently. So again, mutual funds don't exhibit specific characteristics that will always lead them to be the top performer in any given year. And so he also didn't find consistent performance from year to year. Top performers in one year could be the bottom performer the next year, or the middle performer, or what have you. Bottom performers in one year could stay bottom performers or become the top performer the next year. So he basically found that past performance does not predict future performance. I mean, which is really unfortunate for us. If it did, then we could look at how companies did or funds did this year and make our decisions on which funds to purchase at the end of December so that we would hold them throughout the next year and do well. But since past performance doesn't predict future performance, we cannot do that. And it wasn't just Carhart that found that. Lots of researchers have found the very exact thing. And again, this is thousands of mutual funds over decades. It's not just a few mutual funds that they've looked at. There are also financial newsletters and websites that I mentioned before. They're trying to sell you something. They'll basically write a newsletter maybe once a month, charge you maybe $200 a year to receive that newsletter. And in the newsletter, they'll talk about things like, which companies in this industry do we expect to do really well over the next time period. You should buy these companies, stock in these companies. Mark Hulbert basically studied. Oh, shoot. Don't look at that. I gotta close that, sorry. Basically studied about 160 financial newsletters. And and this was over like 12 years, I think. And no, sorry, 22 years. And so he basically said, well, I'm going to form a hypothetical portfolio. This portfolio suggests I should buy these stocks. Sorry, this newsletter suggests I should buy these stocks. This newsletter says I should buy these stocks, and on and on and on. And I'm going to track the performance of these portfolios. And when the newsletter suggests I should sell them, I'll sell them and I'll buy the new recommendations that they make. And he didn't actually do this with real money, but he just pretended, and he looked at how well those portfolios did and how much risk was involved with their recommendations, and also the fees involved with the trading that the newsletters recommended. So anytime the newsletter suggested sell, he had to pay commissions on selling them. When they suggested you buy different stocks to replace the ones they had recommended before, he had to deal with that transaction cost. Again, that reduces your return. So he looked at uh, many of them, and he basically found that there was again no this strategy. I'll put it this way: this strategy did not perform outperform. Oh, my typing, buying and holding an index fund or a collection of index funds. What they generally do is just compare it to the broad overall U.S. stock market, which is represented by the Standard and Poor's 500, which could be represented with the Vanguard 500 index fund, for example. But basically, after considering all the trading, all the expenses, the returns that were generated, buying and holding an index fund was a better deal. Now, I want to. They mentioned this in the book, so I want to go ahead and talk about it. There was a famous at the time newsletter called the Granville Market Letter, and in 1991, it generated a return of 245%. That's a pretty hefty return. But in 1992, the return was a negative 84%. So it looks like if you were to go 245% plus 80 minus, actually plus a minus 84%, that's going to give you a positive 161%, which is still a positive number and a high positive number for a return. So you might still think you would be satisfied, but it doesn't actually work this way because of the geometric mean, which I think I've mentioned before, but I'm not absolutely certain. So let's look at it this way. Let's say I invest $1,000 at the beginning of 1991 and I earn a 245% return. That is going to result in my having at the end of 1991 1,000 times 1 plus the return. Well, the return was 245%, which is, when I write it as a decimal, 2.45. And I need to go 1 plus that 2.45. And then I need to raise it to the power of 1 because that's 1 year that I'm holding it. So that's really going to be 1,000 times 3.45, and I can leave that power of 1 off. So I actually would end up with $3,450 at the end of 1991. That's pretty nice. But the second year, I will or keep all $3,450 in the portfolio that the Granville Market Letter recommended. And the whole portfolio is going to lose 84% that year. So I'm going to lose 84% not on $1,000 but on $3,450. So to find out my ending value after that next year, I need to take this starting amount, 3,450 times 1 plus the rate. The rate this time is going to be 1 plus a minus 0.84, which is going to give me 3,004. Oh, gosh, I thought I'd close that. Uh, so it's going to be 3,450 times, what's that? 0.16, which is going to be a horrible number, $552. So going from a starting amount of 1,000 to an ending amount of $552 is obviously a loss. So which is a loss, not a 61% gain. There are also financial shows on TV, and I know a lot of people who watch them. I am not one of them. And I think a lot of people who don't know much about investing think it's really weird that I don't watch, I as a finance professor don't have an interest in watching these financial shows. I mean, I have on occasion watched them, and I see people going, "Oh, the market's going to drop 10 points this year, or these 10 stocks are great investments." Well, I just find it irritating because I know those people don't know what's really going to happen, and I know that because of the research I've done and other people have done, that those recommendations aren't going to do that well. And I know that over the long run, you're far better off investing in index funds. So when I watch those kind of shows, I just get irritated. But there was a show called, and I'm not sure if it's still around, called Wall Street Week. And they would basically hire experts who would, and I'm putting it in quotes because those experts don't really know what's going to happen with the recommendations that they're making. And they would predict where the market's going to go. And they would actually say, "I think the market's going to be at this level in 6 months." And sometimes a couple of people might be right, but most of the time they were horrible with their predictions. I'll put it this way: their predictions were way off the mark. Mark Hulbert, the same guy who did the financial letters that I mentioned before, he actually watched those shows and he would write down what predictions the experts were making, and he would form fake portfolios of those investments, and he would track them over time and again subtract expenses, commissions that had to be paid when they changed their recommendations, and he'd have to sell the stock from his fake portfolio and buy new ones. And their strategies, there was no strategy that outperformed a buy and hold an index fund over the long run. There are lots of financial magazines like Smart Money and Forbes, and they offer recommendations because those recommendations are what sell the magazines. They have oh gosh, I don't know what I want to call that. Interesting headlines sell magazines, and that ultimately is what their goal is, to sell magazines to try to make money. I had a student a few years ago who asked me to help him choose some mutual funds to invest in because he'd inherited quite a bit of money. And I talked to him for a long time to get an idea of how much risk he was willing to take, what his financial situation was like, and what he thought it would be like in the future. And when I finally recommended a few mutual funds, and they were all index mutual funds with low fees, he his response was, "How boring." Because index funds are boring, but they're also likely in the long run to be the best options for nearly everyone. But you have to stay the course and recognize that the overall stock market has ups and downs, as does the bond market. They're just not as gosh, steep ups and downs. But the recommendation of investing in index funds isn't going to sell a lot of magazines. And journalists are going to be trying to write exciting headlines to sell those magazines. And it's hard to, have somebody in your face going, "This stock is great. This stock is great for this reason, blah, blah, blah." And it's hard sometimes to resist that sales pressure. But it is important to stay the course. Develop a plan and stick with it, and don't let people who don't necessarily know exactly what they're talking about and don't have the knowledge that you might have from having taken Finance 16, don't let them persuade you into a riskier position, a less diversified position, a higher fee position than you should be taking. I know this is not a very exciting chapter, and I'm sorry about that. But I would give chapter 13 a good read. It's got good information in there.